All right, folks. I hope everyone's ready for the panel discussion. I think we have a very exciting topic that we're hoping to cover with all the experts that we have on stage today. So the topic for today is cash flow management for SaaS in 2023, right? So what is cash flow management? If I type out that question on ChatGPT, it literally tells me that, okay, it's monitoring, budgeting, forecasting, and managing your debt, right? But yeah, I think we have an esteemed panel board right here in front of us from different facets of this for us to deep dive into. So not speaking more on this because we have the right people to discuss this, I'm going over to introduce our esteemed panel for today. Starting with Prasanna sir, who is from Upekkha. Prasanna is a passionate founder coach who is on a mission to help founders craft capital-efficient SaaS businesses. He has coached over 100 entrepreneurs during his stints at Upekkha, Microsoft Accelerator, and ICANN. With his extensive work with so many startups, Prasanna has been able to create phenomenal frameworks for early-stage founders to reach the ideal product market fit in a scalable and sustainable way. He has also written extensively on these frameworks, which has been shared at multiple forums. We're so grateful and excited to have you as a panelist with us. Thank you so much for joining us this evening.
Thanks.
Coming to our second panelist, Mr. Sumit. Sumit is the co-founder and CEO of XoXoDay, a fintech SaaS company that provides technology infrastructure to enable businesses to automate rewards, incentives, and payout processes across the value chain. Through products like Plum, Compass, and Impulse, XoXoDay has managed to build brand loyalty and customer retention, improve channel and sales performance, and increase employee engagement. We are stoked to have you here with us and are super keen to hear about your journey of bootstrapping your way to achieving an ARR of over 10 million. So super excited to have you here, Sumit, and to hear from you.
Thank you.
Yeah, thank you. Our next panelist for the evening is Dilip. He is a seasoned and expert banker who has almost 2 decades of experience in banking and financial services and has delivered scalable revenue growth, structured custom solutions, and has been a pioneer in driving exceptional client relationships. Dilip has been with HSBC India for over 16 years with extensive experience in commercial banking, consumer asset management, and retail loans across diverse regions in both North and South India. He currently heads the business banking team focused on mid-sized global and domestic companies across industries and is also heavily involved in startups and new age companies. We are delighted to have you here with us, Dilip, and look forward to your thoughts and observations on the industry.
Thank you.
Thank you so much for joining us. And lastly, the force that made this all happen, to make this event happen, Eklavya Gupta from Recur team. Eklavya is an investor turned entrepreneur with a deep passion in democratizing financing for recurring revenue companies. He has been an investment professional for over 11 years with global experience across capital markets, private equity, and structured credit with Nomura, Kotak, Merrill Lynch, and many more esteemed names with a combined transaction of over 10 billion. Eklavya founded Recur Club with Abhinav Sharwal, which is a revenue exchange that enables founders to raise growth capital without diluting their equity within 48 hours of signing up. So yeah, thank you so much, Eklavya, and super excited to have this panel discussion going. So yeah, to start off, I think starting off with a very macro, generalistic question, right? I think up until last year, for all startups everywhere, it was growth, growth, growth. Like that was the metric that everyone was chasing, right? But I think with this coming financial year and with the funding winter, as we call it, setting in, that focus has slowly started shifting to cash flow management and managing your finances and, monitoring it with a lot more importance as opposed to, the last couple of years. So I think opening the floor for that in terms of your individual thoughts on the changes that have happened over the last couple of years basis this financial, in the scope of this economic climate. So yeah, just opening the forum, would love to hear from each of you from your perspective in terms of what has changed in the industry for a founder in terms of what they look at when they're trying to grow their startup. So yeah, maybe we could start with Prasanna. Yeah.
Sure. So I think, probably 95% of startups don't raise capital. So whether they're a services company or a product company or otherwise, they don't get venture capital. Right?
Sure.
So they don't have risk capital. So whether it's in the past or now, most folks don't have access to risk capital at a very early stage when they don't have cash flows. You have to generate cash flows or you're a dead business. That's the only two options.
True.
In fact, they probably don't even deal with people who don't have revenue, right? So for them, that's not a business. Okay? So, I think there are blips in time when people have more money than what they know what to do with. And at that point of time, then, how much money you have in the bank is not from your customers, but from investors. And then, there's a loss of discipline of what money are you spending for what. And then, of course, everything comes back to a balance. And today, that risk capital has lost its risk appetite and has decided to go and sit in, a SVB account or somewhere else and not come to the founders. And so suddenly, those 4-5% of founders are having to learn things like cash flow management, right? Which for a business, you would think that it's like breathing, right? Does somebody have to teach you breathing or what is oxygen or that you need oxygen? No. So 95% of businesses had to do that every day. Today, 99% of businesses have to do that every day. So I don't see that it's a different situation today than 2 years ago for most founders.
Okay, interesting. So Sumit, anything to add to that in terms of?
Yeah, so I think it goes back to very fundamentals, right? And I always say that a lot of stuff which you learn comes from your childhood.
Sure.
Agarwal, Khandelwal, right? You are a Marwadi and you kind of taught that in life that that every money is very important, cash is king, right? And so that generally is something which lot of the investment monies which are coming at me last year, they are not having the right respect for that whole stuff, that cash is king. And it's not always cash which has come from investor, which is the king, but the cash which comes from customer, which is actually the king. So what has happened is that and this is not new thing, right? It's the whole investment cycle, the whole pendulum which shifts from market being at a high to kind of low, and then going back again, right? So which is generally what's happening now. And I don't want to kind of make people afraid, but I think we're just on the start of it, right? And I'm sure the bankers would be speaking more about it. But what it has done is it's just gone a bit more crazy, and we have not raised a lot of capital. So we were not used to kind of spending a lot of money. But with raise of capital, actually, we did also go through, and I kind of obviously can speak very candid to a founder audience that you tend to spend a lot more, you want to take more risks, you want to do multiple things. With less capital, what it generally does to you is you are very, very focused. You generally think that I will not open 5 markets together, but I'll rather do one market, right? And we did that same thing, we opened 5 markets. Now, when capital is kind of something which comes back to you, asking questions, what is that capital doing? Then you start going back to understanding your basics. So that's the whole cycle which is going in, right? All said and done, I think the whole concept of cash in bank is the only cash which you have. All these debtors, creditors, etc. are something which is good to show to bankers, to Recur Club, to kind of get lines. But what you have in bank is the money which you can just use it. And I think that's the most important thing which is required. And the last part is the market is actually in a place which is generally helpful, and helpful in the sense that when you are kind of building the whole business now, and a lot of them I'm assuming are very early stage startups. I think building in a rough environment is the best thing to do than really in a time when you have a lot of capital, because you don't learn a lot of basics of building a business. Don't want to get into a preaching mode, but I think it's a place where we are also, as a business, we are also trying to conserve a lot of cash because we believe that the next 18 months might be quite crucial.
Right. I think there's been a lot of conversations in general, right? Especially legacy businesses versus startups, whether hyper growth at all costs, is that what we should be chasing versus, a more conservative way to look at it in terms of looking at your actual cash flow. But yeah, Dilip, would love to hear your thoughts here.
First of all, I would say, do I get a feeling that I've been targeted here, or? So all these guys are entrepreneurs. They've done their business. I've stuck onto the same company for many years now. So I think they have more experience than me. But in terms of what as a banker we have seen over the last 3-4 years is that earlier it's a supply demand thing, right? If you have a lot of supply of cash, people use it as they wanted. When the supply comes down or it becomes costly, then people will use it more judiciously, right? And so that we have seen. So earlier, when the US interest rates were 1%, less than 1%, everybody had so much of money, they don't know where to put it. So they just all came into emerging markets. The discounting rates, for example. So any investor will say, okay, if I invested here, this is my future discounted cash flow. So if I invested in startup, this will be, so let me go and invest in startup. Money was available, your discounting rate is 1-2%, right? So everybody had money, people had, and when startups get a lot of money, they tend to spend a lot. But now, as Prasanna said, it's they tighten their purse string. Discounting rates today in the US is 4.5-5%. So then they will expect more returns, better valuations. So funding has really come down, and that's when founders. I've seen founders not doing growth, or as Sumit said, okay, let's not expand so much, let's cut down. In fact, I'm coming to this meeting here after a meeting with a very large EV name, and because of the issues on FAME subsidy, something that they were deciding कि okay 2 साल के बाद ही FAME बंद होगा. But he's saying now I've decided that I've stopped thinking that FAME hai from 1st June. Let me now put my costing structure in such a fashion that I'm not getting any subsidy, and I'll do my costing cash flow analysis basis there. So that's what's happened with startups today, saying that okay, I'm not going to say that I get free money. I will just ensure that I will do my metrics, my expansion, my growth basis the fact that I'm not getting free money or money at a cheaper cost anymore. So that's the fundamental shift that we have seen, because everybody is now preparing for the worst but hoping for the best.
Right. So in general, I think it was brought up also while we were speaking that this is a cyclical thing, right? Like that there's the normal business cycles of like a boom and a bust cycle, right? But basis that and basis these trends, like in general, risk appetite has gone down. Yes, people are a little thinking twice before they spend the money that they have because they know that capital is not easily available, right? But just wanted to get the thoughts from panelists here in terms of, from a founder's perspective, like one is like not overspending on things that don't, bring the returns in a predictable manner, or like being able to manage your cash flows while you're taking those decisions to spend on those particular things, right? But in general, like considering, like keeping aside the seasonality of economic waves, ideally, in your opinion, and I would love to hear from everyone, what would be the one critical metric, from a cash flow analysis point of view, or like a couple of metrics that that a founder or a startup should be focusing on while they make these decisions in terms of, okay, where should I spend this money? I have raised equity. I have this money in bank. How do I spend this money? Should I take more debt? What should be the primary or like the 1-2 primary metrics that a startup should focus on in terms of taking that decision? I'm just opening it. Yeah.
Okay, sure. So I think, the number one metric that any bootstrap founder or founder who's trying to be cash flow positive is always aware of is probably their bank balance at the end of every day.
Yes.
Because that's real.
That's true.
Then profit, EBITDA, EBIT without something else, and a lot of fiction is going on. But how much money is there in the bank is real, right? And I think from a pure cash flow perspective, I think a lot of founders today need to be on top of their receivables. How much money are you going to get in the next week, month? How much of it is getting delayed, so on and so forth, right? If I had to add one more thing, it's that founders need to be far more careful about CAC payback. How much are you spending to acquire a customer,
right,
versus when are you getting that money back into the
flow, right?
Into your bank, right?
Yep.
And so too many founders have spent too much money without understanding, is my CAC payback 3 months, or is it 9 months, or is it more than 12 months? And people have been spending that without really paying attention to that, and looking at things like LTV, which is a little more fluid and not necessarily true. Right? But CAC payback you can measure, and you want to know what your rotation cycle is. Right?
So I think with all the points which Prasanna mentioned, I generally also look at the cash burn, which is very critical, and then also predicting that what will be the cash requirement for the business in the next 6 to 12 months. What I also look at when I look at the whole piece is to understand that what will be the best case scenarios, what will be the base scenario, and be very conservative. I think on the cash bit of it, I'm extremely conservative, and that's something which people might have extremes, but I feel with the cash piece and is the best thing to do. So your debtor realization, when my finance head would come and say it's 30 days, I would put it as 60 days. The payouts, when he says it should happen in 40 days, I would say it would happen in 20 days. I think that generally happens, right? And that is the way we look at the whole cash cycle. So be conservative and then the burn, right? I think one thing what we have done also has been about, I think CAC LTV is something which is a metrics which obviously we look at, but we have been very thoughtful about everything which is required to run the business now versus some green shots, and which green shot we can just push it till we really think that this is the best time to do. And those have been crucial when you're looking at the whole cash part of the business part. A lot of these, I think reading in newspaper helps, because today when you speak about your debtor list, you might have a debtor list which is of big value. How much of those debtors are really getting realized is extremely crucial, right? And because there's a global pressure, a lot of your good customers might also want some delay in payments. They might also want to pull back the strings. Existing contracts might get into a negotiation. So multiple things kind of keep playing in. So the best way when I look at it is just look at the cash burn, reduce your cost centers as much as you can, and last, be very thoughtful about or delay your green shots. Those are the ways we have been looking at the business at this point in time. The only difference between now and what it was in COVID, I think COVID was even worse than this. But the good part of COVID at least was that there were multiple people ready to help you at that time. In the current time, nobody is wanting to help as well, right? So the banks would say, hey, it's like a snowball, right? Investors are saying, I don't want to do. The banks are saying, I don't want to do. Recur would say, I will think. And multiple such stuff will keep happening. I'm not saying that that's what is happening to us, but I'm saying that's what would we as founders all should really be ready to face. And that is the way we should plan our cash.
I'm glad you actually brought that up, because I was going to divert it to maybe Eklavya and Dilip for your thoughts. In a scenario like this, basis considering the fact that capital supply is restricted today, right? From a debt financing or from a banking perspective, what are your thoughts in terms of how a founder should be thinking about debt, right? Like taking debt on their books, or like thinking about, some kind of capital infusion, whether it's through equity, whether it's through a long-term loan with a bank, or if it's through revenue financing, right? In terms of versus all the thoughts that were put on the table in terms of cash and bank, looking at your burn, because that's what's real and like what's actually there in your hands, right? So yeah, would love to hear your thoughts in terms of like how do you think about it, like for a founder in this climate, yeah.
Sure. Just before that, I think I will like one thing to add in those metrics, right? Like I think if you are a cash burning company, I think burn multiple is one of the most important factors, right? Like because you burn and grow, right? It's a business model that you're burning money to grow, which is fine, right? That's the way you build your business. So in current times, that multiple should be as low as possible, less than 1 ideal, right? Like I think most important metric to track. In previous time, around less than 2, etc. was still fine. But if you're a profitable business, if you generate cash from your business, then I think cash flow from operations is the only thing that you should look at, right? There is no other way, because that's the only cash that you get. I think what Sumit was mentioning, that whenever you talk about cash flows in general, right? Like cash flow is always bifurcated into 3 parts, right? Cash flow from operations, cash flow from financing, cash flow from investments. True. Any investor, any financier looking at always breaks down cash flows into 3 parts, right? So businesses fueled on cash flow from financing are probably not the best in the longer run, right? Like your cash flow from operations need to scale up as you scale the business. That's the true testimony, right? So I think for a bootstrap business or a profitable business, cash flow from operations, and if you're burning, then probably a burn multiple in terms of metric. True. But I'll let Dilip add before we come to your next question on debt equity. Anything?
And the burn multiple, again, I think burn multiple depends on the stage. So if you're at early stage, your burn multiple can be 1.5, 2. But as you become, say, if you get an ARR of 30, $40 million, then it should be below 1 is ideally. But one metric that bankers generally see is the leverage. And I think in personal life also, like, if, even in your personal finances, how leveraged are you in terms of your equity to debt? That's very important. Okay, so if you're an early stage company, obviously your leverage is very little because you've not put in much money. But as and when you get investors and friends and family rounds, or institutional investors come in, then you can start leveraging a little more. So I think burn metric and all these are P&L numbers, and I think leverage is a balance sheet number. So these are the two things that I would say is a good metric to look at. And leverage, I think, can be anywhere between 0.5x to say 1.5, 2x. So this is the leverage that generally lenders are comfortable with.
Got it.
But sorry,
Don't put me on a spot now.
no. Just very interesting because I've been wanting to understand
मुझे लगता है ये सब मेरे पीछे पड़े आज.
No, I think it will be helpful for people, I'll be honest, right? Like, because debt to equity, while in stable businesses, equity value is still relatively well defined or in a range, right? Like, because it's market value of equity technically. Unless, for a early to a mid-stage company, equity value shifts drastically with market cycles, multiples change, right? Like from 40x to 5x. Your debt equity on market value, you can't really take that into consideration. So is it like debt to book value of equity that banks see?
No, banks don't do valuation. Okay, we are very bad when it comes to value. We can't value a company. So like Prasanna does care, okay, P multiple itna hai to acha company hai. We don't do that. We don't value company. The reason why we don't do valuation is that we're not looking for exit. Banks or lenders, or at least I can't say about NBFCs in general, but as a banker, if I have given money to a company, I am not looking to exit that company for sure. I am looking at growing my lending. I want the business to grow. So one of the only few people are not looking at. So only if you are looking at an exit will you value the company, right? I'm not looking at exit. I'm looking at the company to grow and my lending to grow. In terms of debt to equity, as I said, we do debt to equity even of 4x and 5x, which means that if you have 1 rupee of equity, we can do 5x of your debt. But that bankers generally do for companies which are positive cash flows and this profitable, because you are not looking at net worth or equity to fund your losses. But at a stage of startups, we are looking at equity to fund your losses, right? So then we can't look at a 4x, 5x kind of a multiple on debt equity. Then we'll have to look at less than 1x, because you need to keep that dry powder to fund losses. We can't, and RBI doesn't allow, a regulator doesn't allow banks to fund losses.
No, guys, yeah. Oh, sorry, Eklavya, you were saying.
No, I think that's right. Like, then that's why it's important, right? Like for people, because a lot of founders come and say, micro is this. In typical, we have heard, we can get debt at 2x of equity, etc. A lot of people have come and said blanketly. But, it's about one's ability to pay. Jenny, what you were asking, right, in terms of debt and equity mix. Yes. I think a mix is very important, obviously. Every type of capital, i.e. equity, debt, alternate financing at Recur that we do, has a type of end use of where you should put that money, right? If you have something of a very long gestation period, something that is very uncertain in terms of output, i.e. starting a new product, starting a new geography, starting a new channel, right? That is when you should use equity money, right? But if you're using money to grow your current business, right, to spend on your CAC, to spend on your working capital, to spend on your software implementations, that is where you should use more, forms of alternate capital like debt and Recur financing, etc. that we have, right? I think because that is more cost effective, right? Let's face it, like no one likes dilution. I can vouch for that, right? Like if you get capital without dilution, the answer would be yes, right? True. So the fact is that, but are you getting that capital as well? The other form of capital at times, right? So I think very, very important. So you should be very, judicious in taking that decision and create a good balance, like a capital efficient stack that I think Prasanna loves to talk about, right? I think that is one of the most important things in today's time, or in ever, right? Like not only today, but I think the good thing is that a lot of SaaS companies, right, like are starting to get during early on in the journey, like a lot of alternate financing as well, right? And they just don't want or have to depend on equity, because again, 5% of businesses raise equity. That doesn't mean you are not a good business. 95% are not good businesses, right? And you may need capital to grow and solve for your working capital cycle delays. So I think it's great that people early on have that option, right? And banking partners are also joining in hands. It's taking time, right? Like to be honest, but it's great to see that the ecosystem would build up, right? And we will promote more companies to that extent.
True. I think
On that piece, Eklavya, and I think since you brought in, and I think more for the audience as well, because I learned it the hard way, right? And that different kind of capital required for different usage of business is so important. And that awareness a lot of times is not aware. Which you rightly identify that what is it required for working capital, that you raise some lines which are different. I think that might be a great piece, my suggestion, if you guys can throw some light over there. And I think I don't want to take that bet. Because that by itself is the biggest learning which you learn. Because by and large, Indians and as all of us individually, and I think you also have that taboo, yaar, tumne loan le liya hai. Right, I think everybody of it, and I'm assuming, are some of you feeling comfortable saying you have to take loan? I don't think how many would be interested in taking a loan because people think, यार बैंक वाले पीछे लग जाएंगे पैसा दे दो, all of those, right? And that's a taboo. Right?
मुझे लगता है ये लोग सब मेरे पीछे bro. Okay. Now tell me, Sumit, is there free money in the market?
No, I'm speaking of, on behalf of people that and hence a lot of people, and I was very cautious to take lines from bank or lines from anything because you don't know which capital. And people were finding that the easiest thing to do is equity, and that you learn the hard way. That equity is the most expensive asset which you have. So I think if both you and Eklavya can kind of give that view, then a lot of people would also be interested to take options from Recur or from banks. Because early on, and I personally have been learning every day with meeting with people like you, that there's so many options available for us to tie to some of the situations which we might go through in the next 12, 18 months.
And I think specifically with respect to SaaS, there is not much understanding, right? Because, even when, whether it's that, credit guarantee, that schemes that were there and so on and so forth. I've never heard of a single startup that's been able to tap into that, literally, right?
The common credit scheme.
The only startup that I know actually had inventory, so therefore, they were comfortable lending on that and stuff like that, right? So, or for most of us, we might have taken a car loan or a bike loan or a house loan, right? So it's like, you're taking it for a particular thing. So people don't necessarily understand, like in a SaaS business, like you said, like what specific expense if I'm doing, then what should I finance that with? I don't think most people don't have that clarity. And the other side of it being, how much is that going to cost you, right? There is a, sticker shock of one kind when you hear, okay, it's 12% or 14% or 18% or whatever. And then the other sticker shock, you only realize that when you exit the business in some way, shape or form, right? There's no price. There's only a board seat price till then. But.
Yeah, I think that's like a good one, considering, we have Dilip from HSBC and like we have two different kinds of like, like debt options on stage itself in terms of, and I just wanted to, I think it's a good thing that, it's a good point to touch in detail, right? Like especially with HSBC launching a 250 million pool for like specifically for startups and like Recur being in the business to like, to basically fund startups at our primary like portfolio companies or companies that we feel would benefit from revenue-based financing our startups. So I think if both of you could throw some light in terms of those specific use cases.
I'll refrain to say anything to him. 250 million is a good number for me.
Okay, now it's my turn to get back. Okay, so now it's really my turn to get back, and I've got something up my sleeve. Okay, so firstly, there's no money in the world that somebody gives you apart from your parents and all that, which you don't have to return. Whether it is equity, whether it's debt, you have to return it in some form or shape. Okay, that's number one.
Yeah.
Bank ka paisa ho ya equity ka paisa, aapko return karna hi karna hai. The banks lend, and I'm not talking about HSBC guys, it's any bank. The banks lend from depositors' money. And there is a regulatory obligation, a fiduciary duty of the bank to ensure that your depositors are not affected. कल को हम ये नहीं बोल सकते सर सॉरी मैंने $250 million स्टार्टअप पे डाल दिया डूब गया तो आपका डिपॉजिट नहीं मिलेगा. LPs understand it. A VC LP is investing to get 10x return, so he's able to take that risk. A depositor is investing it to get that 6-7%. He's not willing to take that. So there's a fiduciary duty. So whatever paper, whatever credit notes that we prepare has to go to RBI. You have to table it in the bank's executive committee. It has to go to RBI. They will audit. They will say, "Isko kyun diya? Yahan pe." So all that happens. So that's the fiduciary duty of any bank. Now coming to the way that we do things, and and then this is my way of telling Prasanna, we do talk to startups which have not had institutional funding. So this is something that we launched 2 years back, and what we've done, especially for SaaS startup, is that most of the spends that we see in tech companies are digital in nature. So you use a card, and typically I've seen founders use their personal card, getting their CIBIL scores all wrong and stuff like this. So what we've done is we are giving actually cards to startups in the name of the company, not in the name of the founder, in the name of the company, which they can use for all the digital spends. It could be as simple as buying a laptop online, or it could be paying your software license fees, or paying on Google, Facebook. A lot of D2C companies use the cards that we give for their Google and Facebook and Amazon spends, right? Any cloud spends. So anything that you buy online, you can use your card for that. And I'll take a step further. Once you become a bigger company, I've seen there's a B2B guy in Bengaluru company, very large B2B guy. He uses my card of 15-20 crores just to buy vendor purchases through a platform. So card is one method that we are using to deliver credit. And this I'm giving for early stage companies. So the card that HSBC gives to SaaS companies is, even if you are revenue generating, we don't put a condition on vintage and all that. We just say if you're revenue generating, you have a net worth, and the card limit that I'll give you is 2 times the net worth. So up to 25 lakh rupees without deposits, we give that. And you will not get into issues like we have seen card company like Kodo and Carbon getting into issue because of State Bank of Mauritius, right? So a lot of startups are going to Kodos and Carbon saying that wahan pe deposit nahi dena hai, wo giving you card. On the back end, what they're doing is they are giving an FLDG to banks, and then basis that. So RBI ne bola, hey, ye kya ho raha hai yaar? No, I didn't give a license to SBM to do this. आपको issue करना तो खुद करो. So we've been doing that. And as I said, we do up to 25 lakhs without security, up to 50 lakhs for some cases. And for existing customers, we have scaled it up to 2-3 crores also. So card is one. And the second, the $250 million fund, which Sumit thinks that I have not deployed, I have deployed 172 of it from Series A onwards to Unicorn. Obviously, and these are ticket size of $2, $3, $4, $5 million. I have showed and Eklavya knows that. We have been discussing a lot, and there are a lot of companies, if you right from logistics to B2B to consumer tech. So today, HSBC banks all the top 3 used car marketplaces in the country. We bank the 2 largest consumer tech in the home furnishing space. We bank all the 6 B2B marketplaces. But these are big companies. But there are smaller ones also, like there are Series A companies, agri-tech companies. So we do anything from $500,000 to $20 million in debt funding, non-dilutive. This is non-dilutive working capital provider. Obviously, we don't give money to invest in IP and all that because there's no tangible asset being created. Right. Because I have to have working capital assets that I do. In fact, we're working with Zozo on a structure where, because they have enterprise clients, like your IBMs and large companies. Right. So they take 90 days, okay, as Sumit said, yeah, 30 days बोलेगा तो मैं 60 ले रहा हूँ, मैं बोलेगा 90 day का ले ले. We are giving them receivable financing structures, okay. So where and it comes with, in today's market, you can do receivable financing with trade credit insurance. There are 4-5 insurance companies, including names like Coface and all that. They will provide insurance. So if the enterprise is not paying you, you don't have a liability. The insurance company will pay you.
Right.
So that's a structure for receivable financing if you're enterprise. But all these are post-shipment. So a services company, SaaS company, selling to a large enterprise, getting stuck with 90-day, 120-day debtor period, you can do receivable financing structures. Okay. And this is live. These are not products on the paper. This is live. We are doing it on the ground. So receivable financing, corporate cards, normal working capital, pre-shipment financing. And then probably I'll take this opportunity to probably announce, and I didn't tell this to Eklavya, we are doing a program with Recur where we have earmarked some amount of money to do a revenue-based financing kind of structure on Recur platform. So we just got the approvals this week and probably will operationalize in the next couple of weeks, saying that, okay, if you have a company which is okay, so we technically are being one of the lenders on their platform. I'm presuming that we are one of the first lenders to be on the platform, which is very unheard. And people sitting in this room might think, yeah, HSBC to हमने कभी सोचा ही नहीं था कि ये करेंगे, because we are there for the large companies. But I think what we are also realizing, it serves 2 purposes. You get early into the company, you become a supporting person to the company, and then you grow along with the company. As I said, we don't look for exit. We want to grow along with the company, increase our thing. And plus, some of these companies do become strategic partners to us.
Right.
Like we use a lot of digital tools in banking in general, be it supply chain financing, be it executing our documents legally and all that digitally. So we do a lot of strategic stuff also. And plus the whole global exercise. So SaaS companies, when the Silicon Valley Bank episode happened, we were bombarded with a lot of request of getting an account open. So sitting in India, you can get account open everywhere, wherever we operate out of. So there are a lot of things that we do beyond giving money. Okay, so giving money is just one part of a banker's job. We do a lot of other things also.
Yeah, and we use them well.
No, I think what Dilip said, right? Like one of the swiftest, because we work with multiple lenders, right? Like investors, NBFCs, now banks, right? Like one of the swiftest in that form, HSBCs, who really understand, right? Like typically, otherwise bank, as Prasanna rightly said, that asset hai to theek hai. Otherwise, you be your way, I am my way, right? Like it's like that. But Jenny, right? Like, and I think Sumit, what you were mentioning, I think very important in terms of business life cycle and what to use, what kind of capital, right? If you have just incorporated, you don't have any revenue, you're setting up a team. It's typically, early on in your journey, no revenue, etc. You will not get, either bank debt or other forms of financing. So either you bootstrap, put in your own money as founders, or you raise equity early on, right? Angel rounds or whatever in the first rounds, accelerated, etc. Once you start generating certain revenue, right? Erstwhile, right? Like not story of today, but banks used to come in like 2-3 years after their incorporation, right? And then there was quite a long period where you were only dependent on equity financing as a founder or running it profitably, right? So that is where we started our business, right? And I think if you're a SaaS company generating $100,000 ARR, we started saying that, hey, you're a decent business, right? Not great scale. You cannot, just be left out, right? Like, and you can raise up to $50,000 subject to, your LTV to CACs and other metrics, etc. If you're a $500,000 business, a $500,000 ARR business, you get up to $250,000, right? So the money keeps on growing with you as you grow, right? But that doesn't mean you don't need equity, right? You can't take that $250,000 today, if you are a 500,000 ARR business, and say, hey, I have cracked India. I think US is great, right? Like I'll move to the US with this money, right? It'll be a very, very foolish decision, right? Like to that extent, because you don't know what will happen in the US, right? Because always think, right? Like as Dilip mentioned, whatever money you are giving, you have to give back. In what time period, right? So can you generate more money by using that capital that you've got into whatever expenditures in that time frame period? If you're very confident, then go for it. If you are not, then don't use that expense from that money, right? It's as simple as that. Like AWS cloud spends, right? Like we fund a lot of cloud spends today, right? Like majority of the SaaS companies, we simply say, because that is one of the major expenses, right? Salaries and cloud spends. Those are the two major expense items. Other than your CAC, where I'm assuming LTV to CAC is good, so that's more for growth. So cloud spends, your predictable salaries for CAC, right? And these are the two expenses that you should use your debt and Recur financing, things like that, right? Alternate forms of financing, which is non-equity in the stage of the business. And always complement equity with other forms of financing, right? Don't say that I will take one or the other. It always has to be a complement between the two. What's the right mix? Depends on business to business. As Dilip says, debt to equity of 1, etc. So it could go up to that, but plan it accordingly. Also take in consideration the time it takes to raise a particular type of money, right? A lot of times we underestimate and say that, oh, I'll need equity in 6 months down the line. That's great. Yeah. But typically it takes longer, right? Like we are aware, for a lot of businesses, it takes around 9 to 12 months. So plan accordingly, right? So yeah, I think these are the 2-3 considerations that you take. So Prasanna, to your point, in terms of type of expenses for SaaS companies, I think where at least we have financed, right? Like I can tell you, and we have seen success in those companies using that, is cloud spends, right? Like your AWS, Google, Azure, your CAC spend on salaries, the channels that work, right? You know that this partnership channel or an inbound channel works for me. You want to spend more on CAC, digital marketing, etc. There, spend using this money. Your LTV to CAC is 2x, 3x, 4x. Your cost for CAC is like for 1x is 1.1x, 1.2x, right? So you will be in the money. You are making that additional delta without. So these are a couple of 2 or 3 things that we have seen typically people, spending, or they should rather. If they are not, they should, right? Equity, you shouldn't spend on that. Equity should be kept for a rainy day, for an uncertain time, right? You don't know, like COVID happened, Sumit said, right? Like people who had equity were safe, right? They could run their business while there was business disruptions, but the business did not shut down, right? Like in the US we saw, right? In the recent times, the last 1 year, we have been seeing a macro downturn. So we have seen a lot of business going under, right? Because of insufficient cash. They may not be bad businesses, it's just the business cycle that you need to be wary of. So keep equity for those uncertain rainy days and in the business use, working capital and growth capital, right, in forms of debt and alternate financing to grow your business in general.
Right. I'd love to hear Sumit's thoughts on this, considering you've raised growth capital through Recur and also raised a $30 million round, in equity. And being a SaaS company, if you could throw some light in terms of how those,
So the way, I think I told that we reached approximately $10 million with a capital or equity raise of only $400,000. I think that generally teaches you a lot. The reason it teaches you a lot because you look at reaching out to a bank, you look at reaching out to every door which is there because you need to finance your capital. So what are the things which we did? First, we built up our business model where we could get cash very fast. So that was the first thing which we kind of started working on. Second thing, we reached out to bank to understand what are the different options available, which is about bill discounting, debt financing, vendor financing, all of those, right? And then what we also understood is that when we started doing more global business, we started seeing more SaaS growing in. We found options which Prasanna was mentioning, that you have businesses which would do your financing based on your subscription fees. Now, what we did was, when we look at all of these models, I think one thing which has to be very thoughtful is that you might get cash, but you have to pay back that cash. I think that is very, very important, because all of us, in the first place, you would say it's fine, but what eventually comes in is that impacts your reputation. You have to keep raising capital in different formats, which could be debt, equity, whatever, as you keep scaling the business. So when we are doing this, we started learning and putting in a lot of maths to use which capital for which purpose, and don't exploit all the capital which is available for you. Because there would be a lot of people who would want to give you capital, and then what generally happens is that you sit on that capital, and when you sit on a lot of capital, you would want to kind of keep spending here and there. So I think the financial hygiene, financial discipline is the most important part in the whole process of raising capital in different formats. Second, when we moved from that avatar where we were always thoughtful and disciplined in raising capital and knowing different options available in the market, when the equity came in, now that was to us was very, very clear about what is the reason for that. And then when we looked at that capital, we primarily looked at that this will not be used for anything around my day-to-day operation. That money is parked for a different purpose, which is my global expansion, which is towards building product which is new, and that's how we really treat. So what it means is that there's a locker where this money is, and you are not allowed to use that money, which means even if you have to, and even today, if the salary has to go, and you have this money in this locker, you cannot use that money, which means the finance guy has to still go get from the customer, get that money, and then use for paying. Otherwise, what would happen is your monies would generally kind of, and I think money is very liquid, right? I think there's no this liquid, this money or that money, but finally, those are the things which you'll be thoughtful. So the equity capital, as it was told, is to more drive growth, more drive new products, more to kind of find ways in terms of expanding your whole portfolio and getting more from your existing customer. The other forms of capital we have been using extremely and exhaustively across features, and we keep reaching out, right? So every time there's a banker who calls me, I said, yeah, come. I think that's always helpful to learn, and I think always helpful to understand what are the new things available, because you might be today, take an example, we have a lot of money which comes from the US, and that US money, because of our customers, we were working with the bank which was offering a certain price. When we spoke to 3 other banks, we realized that we were already losing 3% on that whole process. Because you were not knowing a lot of these things. So be very aware, we speak to a lot of people and then understand some of those pieces as well. So coming back to your question, I think we've been looking at different capitals in different formats and then trying to, as best as possible, to deploy it in the right format so that you, by and large, keep enough for your investors to be happy to fund you next, ensuring your books are kind of taken care of. And I think one last part of this piece is that you also don't depend on only one bank or one banker or one lend, right? So that is also important because we face that, right? I think what happens is different banks work in different methodologies. There's some we were conservative, some which don't become conservative, the CEO change and all of those. So We were working with some bank, all of a sudden the bank changed this whole philosophy. And then you were all dependent on that, and then you realize that, hey, you're on no man's land because you were working on those to have instruments for yourself. So that's another part of it, that have 3, 4, whatever is possible, because there's some regulations which are from RBI, but have that deployed across different banks, different lines from different beaches, because just not debt equity, but also about different vendors with whom you work is very important.
Right, right. In terms of like sort of diversifying your entire debt profile, right? Like
Debt profile as well as the different providers of debt facilities.
correct. Got it. So on that point, right, like Prasanna, just wanted to understand, like Upekkha being one of the most premium accelerators in the country today, how do you go about like sort of advising your startups in terms of the kind of, how do they efficiently manage their capital, right? Whether it's equity capital or debt capital, like depending on an early stage startup, like how do you go about like sort of handholding the founders or startups in terms of like advising them on how to go about that efficiently?
Sure. So I think, early stage, the problem that founders face is really, am I doing something worthwhile, right? More than capital, like whatever I'm doing, whatever product I'm building, whatever service I'm selling, is it worth something to somebody? And so what we really force founders to face and look at is that you have to understand that if you are doing something worthwhile, then the best form of capital to prove that you're doing something worthwhile is actually customer capital. So if you're able to sell whatever you're doing to customers to get money and use that to start running your engine, that is actually not just for the sake of cash flow or not being diluted or whatever. That's like really secondary. The primary thing is, okay, now you can be sure that you are doing something of value, because otherwise you would not see cash in your bank.
Right.
So I think we say that if you focus on that, and especially if you focus on B2B global to start with, for example, there is a lot of money, even with whatever higher interest rates and stuff like that. The companies that are laying off in the US, they have posted record profits and then they're laying off people. So it's not that they don't have money.
Right.
It's not that they're not looking to spend on the right things. They're all hiring like ML teams and AI teams like crazy today. They're spending on LLMs, whatever, right?
Yeah.
So like the focus has to be, am I creating something of value? Can I get money for that? And only then should you be looking at, okay, now this engine is running. If I have to like run this engine more smoothly, then do I need like working capital, or do I have to grow this engine, or do I have to like have multiples of this engine running? Then I need equity capital. And then which parts of this should be, what kind of financing, like Sumit was talking about, comes into the picture. Unfortunately, too many founders, I mean, the mythology of this whole thing is that, you're a successful entrepreneur if you raised lots of money. It seems to be like the prevailing mythology, right? And so people don't understand that, there is something called customer capital, which proves whether your business is worthwhile building before going to a VC. So today, validation seems to be, I raised equity capital, my business is validated, rather than, I got money from customers, so my business is validated, right? So the good part now that I heard, like what you said is phenomenal, that, you guys are supporting entrepreneurs at such an early stage. I don't think any other banks, I've not heard of any other banks doing that. And Recur is able to support entrepreneurs at 100K of revenue, where you've proven that, hey, you know what, it's not easy to get 100K of revenue, right?
Exactly.
The irony is that on the other side, from an equity VC perspective, many cases VCs discount 100K of revenue. You can raise more money if you're at 0 and selling a dream versus once you're at 100, then you have, numbers, and it's harder to raise on the numbers, right? So I think for me, it's not as much about equity or debt or recurring or whatever, but like prove, that what you're doing is worth $1 to somebody, that they're actually ready to give you the money. Then you can figure out, other forms of capital, and then it becomes much easier to have a conversation with these gentlemen saying, you know what, I have something that I've built that's worthwhile. Like, now how do you help me grow this business?
Right.
Absolutely. If you get that customer capital, right, and you have that recurring predictable revenue, I think different forms of capital will chase, right? Like at Recur, that is what we hunt for. If there is predictable recurring revenue, we can, discount that revenue today and get you money, right? As simple as that. So first stepping stone is definitely to earn the customer's trust and earn customers' revenue, right? Before going anywhere out, right? Or just play in the blind pool saying that I have raised equity and I live my own faith.
Yes, that's true. Yeah, in the interest of time, I just wanted to sort of open the forum to questions now, since we've had like a discussion, like we've discussed quite a few points now, from our panelists. So just wanted to open the floor to the audience in terms of any questions that you may have. Please feel free. Like I think we can pass around a mic. So yeah. So yeah, you could just raise your hand if anyone has a question. Yeah.
My name is Rajiv. This question is to Prasanna and Sumit. What we are seeing is a lot of in-housing of solutions are happening. The enterprises, because you guys work with a lot of enterprises and corporates. After 1 year or 2 years, when actually the product will scale, a lot of these enterprises are in-housing the solutions. What is your take on that, and how your startups or like XoXo, how you're dealing with that?
Honestly, I've not been facing a lot of this, right? So I think, to be honest, at least in my products, we've not found companies invest in building that product. I think by and large, the whole SaaS industry is thriving, that people are saying that I will not invest, and I will not invest a lot of capital now, I will invest that capital as we keep growing. Audible, right? Yeah, so I've not been facing, and so not unless Prasanna has faced that. So, and that fear, I think, would not generally be the case if the TAM is also big, right? Even if, let's say, 1% or 0.5% of the customers are going off, let it be. I think the market is big enough. I think the market has to be bigger that people don't take it. But honestly, not faced it, so I don't have an answer to be true.
Yeah, so it's ironic that you asked this question. The first time I've had that conversation was literally yesterday, when a founder told me that a bank, a large bank out of Singapore, has piloted their solution. They found that it works, and they have a captive center in Hyderabad, and now they're going to build it themselves, literally, right? And to me, it sounds really dumb, because these guys are specialists at what they do. They apparently have some developers who are jobless. So now you're going to have developers who are jobless who are going to build what these guys have built. I think that's a nice recipe for them getting locked into something that they have themselves, which is not going to change with the times, and is not going to help them 2 years later when the technology changes or the market landscape changes and now they have to do something else. And so that effort is wasted. So I think we should, one of the reasons to be in a startup community is to know who these gentlemen or whatever pejorative you want for them are, and blackball them and say, like, no, startups work with them, right? So I think there are predators of whatever kind, but this is a marketing solution. So when I heard this, I'm like, why is a bank, they're doing with trying to build a marketing solution in-house? Like, why? The logic escapes me, because they are not experts at this stuff, but they're trying to do it. It's ridiculous. And I know that, for example, Anish of Capillary has said this a few times on stage. In the early days when he used to go and try to sell to retail, at the board level, because this is a large budget item, at the board level he's presenting and one of the board members says, my nephew is a computer science graduate, he can build this. Right? So, I mean, like, you just have to either make customers like that understand that, look, they cannot replicate what you're doing. Or if they're dumb enough to try replicating what you're doing, go back in 6 months, 9 months, 12 months, when they have failed, and then say, like, do you really want this again? Because hopefully they won't try again. I don't know,
But I think one thing which generally come, and we have faced that as well, has been that there's generally in an enterprise there would be one person who would say that, hey, I'm an expert. Yeah. I know your subject more than what you are, even if you've been, and that person would generally say that I'd pick one solution, one subset of your entire solution, 2 other subsets from 2 other solutions, and then try to make it and build my solution. We have faced that with a couple of Indian large banks. I would not name names. Most of them failed and they came back.
Yeah.
But what happens is the organization, the budget owner is able to take that decision, and the budget owner says that I have saved 40% by not taking your tool.
Yeah.
But what they realize is that 2 years they just kept failing to come back and invest more time and effort on that. So
Yeah.
that's what I've also faced, I think, what Prasanna was mentioning.
I have never heard of this in the US. So my advice to founders usually is don't sell in India. Easy way to avoid that problem. If you throw a stone in Bangalore, what are you going to hit? Developer or dog? Developer.
Yeah, my question is, of course, the startups don't really have a luxury to have a CFO to give them suggestions on cash flows and other things. What are the leading indicators which will really give them caution, saying that 2 quarters or at least 1 year down the line, they have to either concentrate on the raising equity round or probably go for financing? Probably any insights on what kind of leading indicators?
To me, I think the best way in some of these cases is forums like this. Meet a lot of entrepreneurs because that's the only way. As founder, your job is to, or my job is to kind of find and learn more about any subject which I'm not knowing about. I cannot say that I don't know ChatGPT and what's happening in AI, ML. That's my role. Even if I don't know, I'll attain. But what you also have is there are multiple opportunities in the market, which is like virtual CFO, which is available. But I would not put a virtual CFO for a guy over there versus, at least on some of these matters, at least very early on, I would want to meet people. You also have time at times when you're a startup. So call banks, figure out, attend events. That to me is the way to look at it. And CFO, we still don't have a CFO, by the way. We still work with a VP finance. But you have to learn those ways because some maths you will start learning as you keep growing. That's the way I would look at it.
Yeah, my answer to that would be one of my mentors, Professor Saras, what she says is, if somebody offers you money, take it, right? And then spend it like you don't have it. Okay. So even if you have exactly like what he said, right? You may have the money in the bank, but don't spend it. There will come a point where you realize that, man, now for this, if I spend this, it can become this. When that happens, then only you spend it. Otherwise, you don't spend it. A lot of mistakes is people raise equity capital and they're like, okay, I have to grow my budget. I will start spending the money. Then you start spending the money. Then you realize that the money didn't, that 1x of money didn't become, even 1.1x of money. Then where are you after that, right? So that's really how I would think about it. It's easy to say, but hard to do. But if you are doing B2B enterprise SaaS, there is no reason why you should be burning money because your customers have a shit ton of money. Your customers who are enterprise, especially outside India, their cost of capital is like ridiculously low even today. So, and like if you're giving them a better performance in terms of their revenues or their costs or whatever you're giving them, if you're giving them a good ROI, right? And you're going to be giving them a 3x ROI or a 5x ROI, or some of you are very generous, you're giving like 10x ROI, 40x ROI kind of things, then man, they should be throwing the money at you. Right? So their cost of capital is like, whatever, 5%, 6%. You're giving them 10x ROI. They cannot get that money by doing whatever because you're giving them 10x ROI. So you have no business raising money from these people. Right? Maybe from him, right? For factoring. But literally you should not be coming to them. Right? The mistake that people make is, one is they're too generous. So I know one gentleman here who has a 40x ROI. Right? He's like super generous. He's like, you give me 1 rupee, I'll give you back 40x of value, 40 rupees of value, or dollars, whatever. Right? Why? Don't do that. So, but if you're doing SMB or if you're doing mid-market and, therefore you have, your customers don't have as much money. Therefore, you're getting it every month or you're getting it in bits and pieces. And, your cycle of collection and whatever, all of those challenges are there, then you definitely need to come here, because if you spend on that CAC in whichever way, shape or form, you're going to make a lot more money. Right? And then equity truly is for the risk kind of stuff, new geographies, new things that you're doing, new product line that you're building, stuff like that. That's where, you should be raising equity, and that has to be like very clearly planned.
I think for few of the metrics, obviously it vary per business, right? Like what you were asking in terms of leading indicators. I think some of them, obviously we have discussed about your ARR, your LTV to CAC. LTV to CAC also is very difficult to judge in the early on days, right? Like, so it's effectively the CAC payback period, I think the second most important metric. And in the initial days, the churn, right? Like, while I know you should not die for it, churn will happen, but, track it and measure it, right? Like if it's increasing at a substantial high rate, you definitely know you need new business at a faster rate, right? Otherwise your revenue will go down. It's as simple math as possible. But at Recur, we'll connect separately. I think we are running out of time as well. But I think we are launching another product, called Recur Insights, which will exactly do what you said, right? Like, because the data is integrated, what is the right time for raising, non-dilutive capital, and what is the right time to, go dilute, depending on your use cases, right? Like, so you can enter and we can chat separately. But I think that's a real problem that people see, right? Like when to raise what capital, and what is the right time, and then plan it that how much time will it take accordingly. So definitely you should do that. CFO services, virtual CFO services, are there, but are not the most dependable, especially as you scale, right? They're more, I think, in my view, could be wrong, more a temporary solution, right? Not bad. They're a quick fix, but you should definitely have someone, in-house. Maybe not a CFO, maybe not a VP, maybe just a finance associate, right? Like to help you with the basic things.
Yes. Yeah. So this for Recur and the banks, maybe. I have a close connect with Upekkha, actually part of the cohort of Upekkha. So especially for I think Prasanna was talking about that. Especially for the new product launch, or we are targeting a new market. So what exactly that you would be viewing? Because a lot of funds you need to really spend in terms of marketing, right? And also making people aware. A lot of funds you will be spending there in terms of cash, and you will be losing a lot of cash there. So what exactly you'll be seeing that? Is it the market potential, how you're going to evaluate that particular startup, which is actually targeting a new market segment? How would you evaluate that this is my potential startup where I need to invest? Because you will not be having a revenue there to really evaluate that, and you will not be having much of a traction visible there. So will you really consider those kind of startups, or even for the banks also at the same time? So will that be skipped off completely? I'm not going into that area, so I'll be only focusing on the startups which already have shown some kind of a revenue. So then there would be a loss for that kind of a startups, right? I think many of them who are there in this particular room, they'll be targeting the new market segments with the new innovation ideas. So what is your take on that actually?
See, cash is fungible, right? At the end of the day, but what the end use is, like if you're entering a new market, right, you don't know what the output will be. Even as a founder, CEO, I think what your role should be, you should assume that you will not generate any money out of it, in my view, right? Like for the next 6 months or 12 months, because then one is taking an equity bet. That if I go, to a new geography, obviously you will have a business plan where that's why you're entering, all of those things you have done. Right. But that's more an equity bet that one is taking, right? Because there is a risk that may not happen with certain probability, right? That probability could be 80%, that probability could be 10%, that probability could be 5%, right? Depending on the different businesses, etc. So you should definitely allocate some equity capital for that and assume that if that doesn't come back, you're okay with it. Right? As a worst case, always plan for worst case, right? Obviously hope for best case and execute for best case, naturally. So when we evaluate, right? So we will evaluate based on your ability to pay that money from your existing business, not from your new business that you will start and generate more money, right? Like, so because that was again an equity play, you don't have that equity upside. For every risk, there is a return, right? Like as Dilip said, there is no free money, right? Equity will take more risk and hence the returns would be, extremely high, right? Like people talk in multiples, not in percentage returns, right? To that extent. So always factor in for that. And while we evaluate, and Dilip can add more, right? Like it's based on your existing business, existing revenues, existing customers that you get, and we will finance you based on that and your ability to pay from that, and not taking into account the other additional revenue there in that case.
So purely it would be based upon the customers and the revenue that we are generating. So not on the market.
Not on the futuristic business plan, etc. Right? Because that is taking equity bet.
Right.
While it's important, right? Like I'm not saying that that you will just say 1 rupee is equivalent whether it comes from whatever. Right? It's not like that. But it's not a material consideration like in equity. Like people talk about TAM, market strategy, this, that, etc. Right. That is why we are fast as well, right? Like we are able to get capital within 48 hours because of some of those reasons, right? We may not get you as much money as an equity guy could. It'll always be a fraction of your ARR.
Right.
But it'll be fast, it'll be good to use, it'll be good to grow your current business.
Thanks.
I think, do we have time for one more? If anyone else. I think it's good.
All right, I think we did overextend our time a bit. So yeah, just in closing, if there's any closing remarks that, maybe we could just as a take home for all the founders who have been sitting here, and we've had covered a lot of ground in this conversation, but I thought it'll be nice to have one last tidbit, which can be our closing remarks in terms of this discussion, something that could be a take home, something that every founder can go back with in terms of a summary of tonight's discussion.
I think very simply put, if you manage your cash flows efficiently, you can grow your business much well and with peace. As a founder, you don't want troubles on your head, right? So plan it well so that you don't get stuck in problems. And managing cash flows, we've all discussed, whether from customer capital, whether from equity capital at a point in time, whether from bank debt, whether from, Recur capital, which comes in early on. There are different stages, but plan it well ahead, be prepared, plan for the worst, so that you can build better, and you want to live in peace as well, right? You don't want as a founder, you're always in problem and trouble, right? So I think that would be the biggest takeaway for me, and different ways to manage cash flows that we have all discussed.
My takeaway, what Sumit was mentioning, the network, keep understanding what's available in the market, because whenever even I go to these networking, I get a lot of ideas of how to structure products. Some of the terminologies that you guys burn multiple and all that, these were new to me, right? We don't use that in regular traditional lending. So when you network, when you meet people, keep understanding what's available in the market, and I think keep your eyes and ears open all the time, just to understand what's really there. Because Prasanna said, there is a CGT MSME scheme for startups where government gives guarantees up to 10 crores of lending, okay? Now, but obviously that I also looked at it very closely. It's slightly flawed. It's difficult to get government to give guarantees to everything, but it's available in the market. And if you use the right channels, if you're eligible, you should go and do it. So there's a lot of avenues available in the market, but it's just that you need to know what's available, and that through networking forums you get it.
Thank you, Dilip. Sumit?
So I think the first line which I started, cash is king, and the more you get from customer, that's best for you.
Yeah. So I think actionably, I would say that most of the founders that I speak to on a regular basis, they don't actually have an MIS report, right? You don't have an Excel sheet at the end of the month which actually says where did the money go, where did the money come from, how much money is outstanding, how much money is in the bank, what's your next month spend going to be, and stuff like that. People don't have that, and it doesn't actually cost a lot on top of what your regular CA charges you to build that. It takes a little bit of discipline, but if you build that and look at that month on month, you will learn a lot about your own business. And too many people who are engineers don't do that, because you don't even know that something like that exists, right? So I would say, if you don't have an MIS Excel sheet, please find a CA or an accountant or whoever who understands SaaS businesses. So if you're a SaaS business, you have to find an accountant or a CA or whoever who can build that report for a SaaS business, because it's different for regular businesses and SaaS businesses, right? But find one and get that done. It will cost you next to nothing, but the insight you will get from that will be phenomenal.
Great. Thank you so much. Thank you, Prasanna. Thank you, Sumit. Thank you, Dilip. Thank you, Eklavya. And thank you for all for patiently waiting.